just in terms of your current read on things, given potentially the increase in tensions as a result of the arrest in Canada of a very senior executive at Huawei. Does it mean something? Does it figure into the way you think about stocks and or potentially the economy in the months ahead?
You know, I'm a little bit conflicted on this because I'm really quite bullish on the backdrop. I think this sell-off is unwarranted. On the other hand, I was really surprised that the news out of the G20 meeting was that everyone was going to, hug and just put off more tensions. And so to a certain extent, I was expecting bad news. And perhaps that's what's come through. I didn't think that Trump.
Well, we got we had a one-day respite.
We had a one-day. Yeah, I mean, ultimately, there's a long-term issue here, which is intellectual property and access to Chinese markets, and basically a lopsided agreement. And I think it goes beyond: are we going to tariff things over the near term, and are we going to get to a point where this is a better situation? And I think it's not going to be something that's solved in 90 days, and we have to probably get used to that.
Meaning what? How does that affect your overall view as we head into next year?
Well, I mean, in the near term, first of all, what you have is a lot of companies are stockpiling inventory, so you're seeing some pickup in inventories in the GDP data, so that even if this thing gets uglier, it's probably not as disruptive as you think, but the news headlines are going to continue to be disruptive, and that means the volatility probably stays a little bit higher.
Your general take heading into the fall has been earnings are great, and they're likely to stay strong. And your target has been aggressive as a result, 3,000?
Yeah, but my call was that next year we were going to see a 7 to 8% EPS number. Why? Because this year's number is jimmied higher by taxes and stimulus and frankly oil prices as well. And the same thing with the economy. So next year, I think the deceleration is not properly characterized, and that we're decelerating back towards a reasonable, sustainable trend from something that we all knew was not sustainable. So I don't think the market, if we have a 2.5 GDP next year and 7 to 8% EPS, and the Fed says, guys, we're done, we do 1 or 2 more, and we've successfully moved away from zero policy back towards 2.5 or 2.75 on Fed funds, why is that bad? I know, putting trade aside, what's wrong with that?
No, it's probably nothing.
Probably nothing.
Although depending on where stocks are at the time.
And I think stocks probably re-rate on that, especially from these levels of volatility.
What if wages come in at 3.1 tomorrow? Highest since 09, that's okay too?
Well, it depends on how you look at it. What it means is you have a strong consumer. You know, we're generating a boatload of jobs, and so people are now making, there's more income coming in than there is inflation against that. And it's beginning to squeeze corporate margins, but it's not yet shown up as a problem. Next year, we think as we move into the year, yes, it's going to start to touch corporate margins, but not yet.
All right, Lou, we haven't forgot about you. How do you run a growth portfolio in this environment? What do you find yourself thinking about on days like today?
On days like today, when you see the volatility tick up, I think the most important thing to remember is you need to have an extended investment horizon. Again, we're playing a lot of these big picture secular trends that are in the market today that act as strong tailwinds to growth. We can't control the day-to-day news flow, the day-to-day volatility, and we're not short-term traders of stocks. So what we want to do is try to find the best possible long-term investments we can find, and those are the companies with these strong secular tailwinds behind them.